आई थिंक 1-2 मिनट वेट कर लेते हैं, जस्ट 2 मिनट्स। अक्सर लोग
ओके
5 मिनट 1-2 मिनट वेट कर लेते हैं। Webinar hosted by CFA Society Pakistan on a webinar titled Debt Management Strategy in a Changing Macroeconomic Backdrop. To talk about this topic, we have invited Mr. Mohammad Zahid, DG Debt, as we feel that he is the best person to speak on this subject. And in terms of the topic of the timing, I think this is the perfect time to talk on this this subject because the central bank has, as we know, that it has changed the monetary policy regime with the token 25 basis point interest rate in its last monetary policy statement announced in September. At the same time, we have seen that there's a quite lot of activity and a lot of happening in the debt capital market, where we have seen a shift in yield curve, an increase in sovereign yields. At the same time, we are also seeing that IMF program is also under discussion, the revival of the program. So I think we feel that this is the best time to hear from the best person, the DG Debt of the Ministry of Finance, to talk on this subject. So I would like to thank Mr. Mohammad Zahid for taking our time to speak on this subject. I also like to thank everyone for taking our time and join this session. For housekeeping rules, just to remind you that this session is for 1 hour, that will be followed by, that will include a brief presentation by the DG Debt, and then there will be followed by a question and answer session. All participants will be muted for this session, and the question will be taken through chat box. You can post your question and I will request the DG Debt to take as much question as it can during this allocated time. So without taking further time, I will hand over the session to DG Debt for the presentation.
Thank you so much, Mr. Sajjad, for giving me this opportunity. I would also like to thank all the market participants who choose to participate in the webinar. Yes, I have prepared a presentation for this webinar, but before we go into specific of the public debt strategy, I would like to speak slightly on changing macroeconomic paradigm in Pakistan and around the world. So if we analyze Pakistan's situation of last 2.5 years, we had interest rate environment at the start of FY20, whereby policy rate peaked at 13.25% per annum. And then from Feb to June 2020, we had witnessed a declining interest rate environment, whereby policy rate reached to 7.7% per annum in a short period of time following the pandemic. So interest rate remained stable for a year or so, and now we are in an environment whereby market is expecting a rise in interest rate, also supported by somewhat higher inflation number. So I would like to say here that headline inflation rates have increased rapidly around the world, regardless of their categorization in terms of advanced, emerging, or developing economies. And Pakistan is no exception. In most cases, rising inflation reflect pandemic-related supply-demand mismatches and higher commodity prices compared to their low base from a year ago. I was referring to the World Economic Outlook published by the IMF in October a few days ago. IMF projected that for the most part of the world, pricing pressure are expected to subside in 2022. I also believe that this phase is not permanent, and such inflationary pressure cannot be sustained over a longer period of time in any case. So now I would like to speak more about the presentation. So can we please move on to the next slide, please? Right, so this presentation will have 4 sections. The first one is public debt statistics, whereby I would like to share the composition of public debt with you and what are the lending instruments or borrowing sources which are available to the government for financing of fiscal deficit. The second one is debt management strategy, as you may be aware that we had published our debt management strategy in 2000 for a period of 2020 for a period of 4 years from FY20 to FY23, whereby we specified certain thresholds of the risk indicator of the debt portfolio, as well as we also specified few annual targets which the government intends to achieve over a medium term. And I also would like to share some recent development, like what was the borrowing operation of the government in the last quarter, or in the first quarter of this fiscal year. The next one is the financing plan of the government. I will share the financing plan, that what fiscal deficit government is projecting for this fiscal year, and what would be the funding sources to finance that deficit. And in the last section, I will share the updates and what the market can expect from the government in terms of its borrowing operations. Next, please. So this is the pretty much on the public debt portfolio. We have a portfolio of around 40 trillion of public debt, out of which 26 trillion was from the domestic sources and 14 trillion was approximately from the external sources. Our debt to GDP ratio was 83.56% at the end of June 2021, while it was around 87.59% at the end of last fiscal year. Here I would like to highlight that government of Pakistan has done pretty well in terms of managing the debt burden of the country. Because in the pandemic period, in fact, I would say that Pakistan debt to GDP ratio has witnessed one of the smallest increase in the world during the pandemic. In 2020, world debt to GDP ratio increased by over 13 percentage point, and Pakistan debt to GDP ratio hardly increased less than 2%. Moreover, if you also compare the regional economies like Sri Lanka, India, Bangladesh, you will come to know that their debt to GDP ratio was increased by a much higher proportion compared with the Pakistan. So I believe that we did well in terms of managing our debt burden during the pandemic, and in this fiscal year, the last one, we witnessed 4% decrease in the debt to GDP ratio, and in the ongoing fiscal year, we are further expecting 2 to 3% reduction in our debt to GDP ratio. Next, please. Okay, so this is our domestic debt profile. We traditionally classify our domestic debt in 3 categories: permanent debt, floating debt, and unfunded debt. Permanent debt is around 60% of the GDP. It contains 2 major instruments, PIBs and Sukuk, along with the price bond. So if you see, during the last fiscal year, we witnessed good growth in PIB stock as well as in Sukuk stock, but we witnessed retirement in the price bond. So in case of price bond, as you may be aware, that government has discontinued various price bonds from the circulation, like 40,000, 25,000, 15,000, and 7,500, to improve the documentation in the economy. That is the reason why that we are witnessing gradual reduction in the price bond portfolio. And I think government plans to completely phase out these bearer instruments from the circulation. The objective is to improve the documentation of the economy, and holders are given various options to convert these price bonds. Like they can register for the premium price bond, they can invest in the other national savings schemes, and they can also have the encashment in their bank account. So that is on the permanent debt. In the floating debt, we only have T-bills. So T-bill constitute around 25% of our debt portfolio. And I think even this number is higher. If we compare the world averages, this number is still higher. We would like to reduce it further. And unfunded debt remain more or less stable. Here, unfunded debt means the national savings scheme mainly. And I would like to share one thing here, that government of Pakistan has actually barred the institutional investor in investing in national savings schemes. And accordingly, now the retail investors can only invest, and these institutional investor corporates can only invest in the government security through competition in the primary and secondary market. So I believe that this was a good reform undertaken by the present government. Next, please. So there's another way to look at the domestic debt profile. So here I categorize the domestic debt into 2 categories. One is government securities, the other one is savings schemes, or maybe you can say that the non-bank debt. So in government securities, the quantum is around 22.14 trillion, which is around 84% of the total domestic debt portfolio. So here the banks are the major player. The share of the banks in the government securities are 49%, or 49% at end June 2020-21. State Bank held around 25%, and the other companies like insurance, pension funds, and mutual funds has a proportion of around 10% government security. So banks are the dominant player in the government securities market. And then we have a national savings scheme, the share of which is declining. The reason I have already mentioned that price bond is witnessing declining trend due to the encashment, due to the withdrawal of circulation. So this is pretty much on the domestic debt profile. Can we move on to the next one, please? Yeah, so this is an important slide. So I would like to basically, before going into specific, I would like to tell the background on this slide. So we may all agree that issuing debt through variety of instruments has a significant advantages for the government as well as for the investors. The government has the option to borrow through multiple instruments and remain in a better position to lower its borrowing cost and manage the fiscal risk arising out of these borrowing operations. Investors, on the other hand, also have more options to choose investment which are closer to their investment horizon, income preferences, and risk appetite. It also helped to expand and diversify the investor base in government security, deepening of capital market, and promotion of the saving culture in the economy. So, Government of Pakistan securities portfolio had been traditionally limited to the conventional security, including short-term T-bills and medium-term, long-term fixed-rate Pakistan investment bond. Sharia-compliant instrument program had been in place for many years, but it still constitutes a very small proportion of the domestic government securities market. The lack of diversification in terms of borrowing instruments has historically pushed the government into a borrowing relatively larger amount through long-term fixed-rate debt instruments during periods of high interest rate environment. In doing this, government has been driven by a combination of high fiscal needs and the desire to extend and maintain the average maturities of the government securities portfolio. This translated into high borrowing costs for a longer period of time. In addition, availability of the limited government instrument has over the year also deprived the many investors for investing in accordance with their investment horizon and risk appetite. So keeping in view this, in May 2018, government introduced a conventional long-term 10-year maturity floating rate PIB, which was a very good addition to its securities portfolio. It enabled the government to borrow for a longer period without looking into fixed rate borrowing cost. The instrument was also useful for the investors who prefer to avoid fluctuation in their market values of their investment. Subsequently, more tenor were added with various coupon payment frequencies in the floating bond portfolio. As we were of the view that these instruments will remain attractive for investors with a short to medium term horizon, and these would be preferred by the banks, mutual funds, general insurance companies, pension fund, provident fund, gratuity funds, and retail investors. In addition to the development of debt capital market, these instruments have proved to be useful for the government to lower its long-term borrowing costs, lengthening of maturity profile, and brought stability in the prices of the government securities. During periods of the temporary rising interest rate environment, which is presently the case in case of Pakistan, floating rate instruments remains a better choice both by the government and the investor. The government does not remain locked into high borrowing costs for a longer period of time. Government of Pakistan also introduced 2-year floating rate bond to attract even more diversified investor base. The rationale of this instrument was to further minimize the interest rate risk of the floating rate instruments. Existing 3-month T-bill of floating rate PIBs carries interest rate risk of at least 3 months, while this instrument carries interest rate risk of only 2 weeks, apart from offering a reasonable spread over the 3-month T-bill yield. I sincerely believe that government has already done its part in terms of offering wide range of instruments to the market, and we expect that market would also take a rational decision in terms of choosing the right instrument and may not follow the traditional path when these instruments were not available to the market. Having said that, it is not the case that we do not want to issue the fixed rate bond. We do want to issue the fixed rate bond, but we would be very mindful in terms of cost and risk of the such borrowing operations. So now specific to this slide, I would like to say that in the last fiscal year, our floating rate exposure has increased from 53% to 60%, supported by both higher issuance of T-bill, but much higher issuance of floating rate bond in the last fiscal year. And accordingly, although we have issued fixed rate bond in the last fiscal year, but still higher issuance in floating rate bonds and T-bill overcome that issuance, and accordingly, our fixed rate share has reduced from 47% to 40% in the last fiscal year. Next, please. Right. So this is external debt profile. I'm not sure whether we have conducted any such session whereby we share more information on the external debt. So I would like to share this now, because if you see our profile, we have external debt portfolio of around $86 billion, and out of which $41 billion is from the multilateral sources. World Bank has provided us 18 billion to us, and followed by ADB around 13 billion, and then the IMF. So around 48% of our debt is from the multilateral sources, and around 30% or 26 billion equivalent is around from the bilateral sources. So if you add up, you will come to know that around 78% of our external public debt portfolio is on the concessional terms, because we usually get these loans on a very concessional terms, like low cost and high tenor. But we have also witnessed some increase in our commercial portfolio. Like in the last fiscal year, we issued Eurobond of around $2.5 billion. And we are also raising money through the commercial banks and through the Naya Pakistan certificate and Pakistan Banao certificate. That's why our external debt share is from the commercial sources is also increasing. But if you value it on an overall basis, we still have around 78% of our debt portfolio, which is on a very favorable terms. Next, please. All right, so I would like to share this important information with you, because usually we get a very high number of government debt repayments that government needs to pay the $14 billion equivalent payment against its external debt. And I think this number is more or less constant over the medium term. Government of Pakistan will be required to pay around $13 to $14 billion over the next 3 to 4 years. So let me share the bifurcation of this number, so that you may come to know that this number may not be that high when we bifurcate them into the refinancing number and the new requirement. So out of this 14 billion, you can see that 4 billion is from the safe channel deposit. These loans were obtained. I think we started obtaining these loans from 2013 and onward, and we are getting them rolled over on an annual basis. So we believe that we are going to roll over these maturities on an annual basis, and we do not feel any cause of concern with respect to this 4 billion. The next big item is the loan from the Chinese commercial bank. Again, we are rolling over these loans since years, and again, and over the medium term, we are positive that we are going to roll over these from the Chinese commercial bank. And the next big item is refinancing of foreign banks loan, which is from the commercial bank, Middle Eastern Commercial Bank. So again, this is again the refinancing item. We are getting them rolled over since year. And again, over the next few years, we do not feel any cause of concern in getting them rolled over. So if you add up these three items, you will come to know that out of that 14 billion, 9 billion is the refinancing items. We are going to refinance them in any case. The only thing which need to be worried about is around 5 billion maturity, which is 1 billion is from the Eurobond. And I think we are going to pay 1 billion every year for next 2 to 3 years against the maturing Eurobond. And rest of the maturity is basically due on the multilateral and bilateral loan portfolio. So I will share the detailed plan in the subsequent slide, but let me tell you with respect to Eurobonds. The government of Pakistan has prepared a plan whereby government of Pakistan will maintain its presence in the international capital market on a regular basis. And we are going to issue around 3.5 billion worth of Eurobond or Sukuk or Panda bond or green bond. So I'm going to share that detail in the subsequent slide, but 3.5 billion issuance is in the plan of the government of Pakistan. we are now going to raise these loans from the international capital market, and we will maintain our presence in the international capital market on a regular basis. And as far as multilateral and bilateral loans are concerned, I think we have a good pipeline of project and policy loans from the World Bank, ADB, as well. We are expecting good inflows from the IMF in this fiscal year. So I think meeting this maturity is not the cause of concern for the government of Pakistan with respect to the debt management. Next, please. All right. So this is the medium-term debt strategy of the government, wherein we define few debt risk indicators. I think that is too technical. I will try my best to explain it in a simple term, but please pardon me on that, because we are working on this since year, and we may not be able to explain it well, but still I will try my best. So we defined 5 indicators, in fact 6 indicators in the medium-term debt management strategy of the government, that for example, the first indicator is share of external debt in public debt. We had defined a ceiling of 40%, that government of Pakistan would not like to go beyond 40% in terms of its external debt in public debt. So our share of external debt of the public debt should not exceed 40%. We were 36% at the end of 2020 and 34% at the end of 2020-21. Then comes the average time to maturity of domestic and external debt. It is an average maturity, because we issue even a 20-year bond or 15-year bond, but we do issue some bond of like 3-year, 2-year, and even a T-bill. So when we average these maturities out, government of Pakistan set the threshold of 3.5 years. Traditionally, it was around 1.5 year, like in 2017-18, but now it is around 3.6 year. We would like to either maintain it or increase it in the medium term. And similarly, the case is for the external debt. We would like to maintain our average time to maturity of external debt to 6.5 year minimum. Right now, it is 6.8 year. So if we contract the long-term loan in future, so this is going to be obviously increased by our strategy. And one of the important indicators is gross funding need. This is the indicator which IMF also evaluate in its debt sustainability analysis. So gross financing need is just sum of fiscal deficit and the maturity which are becoming due in the next 12 months. So this is around 28. This was around 28% at the end of FY21, improving from 31% at the end of FY 2020. So we have witnessed improvement, but still our GFN is very high. We have set a target of, I think, around 24% over the next 2 years, and we are positive that we are going to achieve that target. We also would like to increase the share of Sharia compliant instrument in government securities. As I told you earlier, that the Sharia compliant program is there for years, but it still constitutes a very small proportion of the government securities portfolio. So we set the target of 2 years for FY20, and then we set the target of 5 years for FY 2021. But we end up at 3.9% of the total government securities. The reason was that from July, I think we last issued in January 2020-21, and then there was a gap of 5 months. Actually, we do not had the asset available for the issuance of Sukuk at that time. But in the subsequent slide, I would share some good news on that front as well. And similarly, the last indicator is share of fixed debt in government securities. Obviously, government preference is to borrow in the fixed debt securities. And we set the target of minimum target of 25% for a 4-year period. And we stood at 30% at the end of FY 2021. Next, please. Okay, so I would like to share some recent development. Like you are aware that we were previously issuing floating rate bonds in semi-annual with semi-annual coupon payment frequency and quarterly coupon payment frequency. Now, with the feedback which we received from the market, we basically consolidated the instrument. Now we are only issuing 2-year and 3-year floating rate bonds with quarterly coupon payment frequency and 5-year bond with semi-annual coupon payment frequency. So And I would like to also share that we are going to reintroduce 10 years floating rate PIB with semi-annual coupon payment frequency, and you will see that in the upcoming auction calendar of the government. And I would also like to share that Government of Pakistan recently formulated a policy on buyback of government securities, and that is available on the financial website. We do like to undertake some buyback transaction to ensure that we end up reducing the fragmentation of debt instruments, but we will remain within the parameters specified in that policy. So I would encourage all the market participants to please review that policy, and we may have a discussion subsequently on that. We have also formulated an asset framework whereby we intend to issue Sukuk not only on a Jara basis. Presently, we are only issuing Sukuk on a Jara basis, and the limitation is that we do not have unlimited asset available with us. So I would say that Government of Pakistan is considering to issue Sukuk in future on asset structure like Murabba, Mudarba, Wakala. So there are many structures which are given in the asset framework that is also available on the Finance Joint website. So I would also request you to have a look at this and let me know your feedback. We issued Eurobond in the international capital market in July, and we mobilized 1 billion through the TAP issuances. As the market may be aware that Government of Pakistan for the first time has registered its medium-term global note program, whereby we can tap the market quite easily. Right now, we are in the process of getting a Sukuk international program registered in the international capital market. And then again, we would have leverage to issue bond at any time within the stated period of 12 months. So that is underway. We are quite positive that in November, we are going to register a Sukuk program, and the debut issues will follow shortly, depending upon the market condition and the advice of the financial advisor. And the last one is that during the last quarter, which was the first quarter of this fiscal year, we financed most of the deficit through the issuance of domestic bonds. Next, please. All right, so this is the third section of my presentation. So I would like to share the financing plan of the government. Government is basically anticipating around 4 billion federal fiscal deficit in this fiscal year. And we would like to finance it through obviously domestic and external sources. So the financing breakup is that the 2.5 billion would be raised from the domestic market and national savings schemes, out of which we are going to issue 1 trillion worth of 2.5 trillion from the domestic market, out of which we are going to issue 1 trillion worth of domestic Sukuk, if not more. Because I would like to share here is that we are now list of asset available from the NHA. These are various motorways, and also we have 3 airports available: Multan Airport, Islamabad Airport, and Lahore Airport. We are getting them valuated. Once we get the valuation, we are going to announce the regular issuance calendar for the Sukuk as well. Right now, we did one standalone transaction of 200 billion on I believe 29th September. Now, once we get the valuation of all these assets, we are going to announce the proper auction calendar for the entire period of this fiscal year. So this is a positive development. So we are targeting 1 trillion from the domestic Sukuk issuance, if not more. On the external front, I have already explained you that we are going to basically issue more and more Eurobonds and Sukuk. We are also looking at the possibility of green bond issuances. I have discussed that with the financial advisor, and they basically informed me that even under the existing MTN program of the government, we can issue the green bond as well. And we are also planning to issue, in fact, the Panda bond in the Chinese capital market. The preparation are underway. We are quite hopeful that it will take us around 4 to 5 months to issue a Panda bond in the Chinese capital market, but work is underway to issue a Panda bond in the Chinese capital market. And we are expecting a sizable inflows from the multilateral and bilateral sources in this fiscal year. So there are a lot of projects loan, policy loan, as well as we are anticipating good inflows from the IMF as well. So this is pretty much on the borrowing plan. Can we move on to the last slide, please? Right. So I would say that market can expect that government is willing to issue more and more bond, either fixed or floating, but we would be very mindful in terms of cost and risk of such borrowing operations. In the last few sessions, we informed the market that the government has issued a procedure for the auction whereby certain limits have been defined. We will try our best to adhere to that limit to ensure the auction discipline. So as per the permissible limit, we can deviate 50% from the pre-announced auction target in any particular auction, 25% on a quarterly basis and 10% on a yearly basis. We may have a session on this. Like I can tell you that we tried our best to follow that auction procedure, but we do violate it in some instances, which we may discuss it in subsequently. So, but my plan is that we are going to adhere to the auction procedure which we have notified. This is I have already explained that government is going to issue a lot of Sharia compliant securities in this fiscal year. And on the external front, we are anticipating good inflows from the multilateral sources and the bilateral sources, and we will maintain our regular presence in the international capital market with the sizable issuances. So that is from my side. I would welcome any question now. I will end here. Thank you so very much once again. Sajjad, I think you are muted.
Thank you so much, Umar Saab, for this very insightful presentation that contains a lot of numbers that the market is wanted it. So I will start the Q&A session with a question from my side. The government has budgeted 2.75 trillion of the domestic debt servicing. So my question is that what were your estimates for interest rate for this fiscal year while you are arriving at a domestic debt servicing number? And as we have seen that there was quite a lot of upside in the sovereign yields in the secondary market, where we have seen just 25 basis point increase in policy rate. So are you surprised by this large increase in the sovereign yields in the secondary market? And we have already, market is expecting another hike, maybe many hikes in the upcoming monetary policy statement. How this will change your debt servicing cost for this FY22?
So thank you so much, Sajjad, for this question. So we basically, when we were preparing the budget of the 2.7 trillion worth of interest servicing, we assumed an average rate of around 7.5% for T-bill. And obviously we added the spread of bonds, which we traditionally offer on these maturities. So 7.5% on an average was assumed to be the policy rate, because when we prepare the budget, we always have some cushion in terms of debt servicing. Like in the last fiscal year, we had a debt servicing of around 2.95, interest servicing of around 2.95 trillion, and we end up having 2.75 trillion. So there was a reduction of 200 billion from our estimate. Primarily, one factor was the DSSI initiative, whereby we get the interest servicing deferred, but also our projection is always on a conservative side. So we budgeted 7.5% on an average policy rate for our 2.75 trillion calculation of interest rate. I hope I'm clear. I tried to provide you answer.
You mentioned that you are expecting a reduction in debt to GDP ratio this year. So my question is that when we have seen a large currency devaluation for this year, and we have around $86 billion of external debt that constitute around 35% of the total debt. On the other hand, the kind of environment that we are foreseeing, do you still expect that you see this debt to GDP ratio will decline for this FY22? Because external debt, when will be translated obviously into rupee term, and the currency devaluation will obviously increase that number. So do you still expect after this devaluation, and maybe more is coming as we are seeing pressure on our external account? So will your projection are still there that it will be on a declining path of our total debt, public debt?
Yeah, we do believe that we are going to have reduction in debt to GDP ratio. If you see our GDP number, it's around 54 trillion now. It is going to be around 54 trillion at the end of the next fiscal year. So we are anticipating good GDP number, both supported by the real GDP growth, and inflation is already very high. So I think the denominator is going to be increased to a greater extent. But I do agree that we have not forecasted such an exchange rate depreciation while we were preparing the projection. So we initially prepared a projection of around 4 percentage point reduction in debt to GDP ratio. So now we narrowed it down to 2% because of these changes which you have mentioned.
Okay, then last question from my side. That you mentioned that their external requirement, borrowing financing requirement is 14 trillion, $14 billion, sorry. So when we are seeing that already there is pressure on external account, and as per even the SPP projection that it can be around 3% of the GDP for this year. So don't you see that there will be either there will be more pressure on our reserves that are around SPP reserves $19 billion. So whether we will be able to we might see some reduction of our reserves, or to build the reserve we have to borrow more to finance our current account, this rising current account deficit. So are you still see that their external requirement will be $14 billion for this year?
I think 14 billion is the only external debt repayment of the external public debt repayment. But let me tell you one thing. I only shared the repayment side, but we are anticipating around 21 billion worth of new inflows in this fiscal year, both from the Euro bonds and multilateral institution. And I told you that out of that 14 billion, 9 billion is the refinancing items. So our fresh requirement is only 5 billion, out of which, against which we are anticipating around, against that 5 billion, we are anticipating around, you can say 12 billion from in the form of fresh inflows from the multilateral and bilateral sources. And the positive surprise which came is in the form of the allocation to STR. We got around 2.8 billion worth of STR from the IMF. And that is basically, we previously do not budgeted at the time of budget. So I think things are moving in a positive direction, although I agree that current account deficit will increase beyond the projected level. But at the same time, we are getting inflows from various sources which we previously did not budgeted. So we are positive that we will be able to manage without putting pressure on our reserves.
Okay. We have many questions in the chat box. The first question is from Umar Ali Sheikh. He asked that, with all due respect, don't you believe that the government has missed the opportunity to raise debt through fixed rate PIBs when the yields were low during FY20 and 21? How do you think the ratio will change when interest rate will peak to 12% or 13%? Will investors like commercial banks be interested in floating rate bond then?
I think we can always say this after something has passed. I believe that we issued a lot of bonds from April 2021 onward, when market started participating in these bonds. I think on an average we issued 200 billion in every auction, and I think 200 billion against a target of 150 billion is quite a reasonable size. I agree that market participated with a larger volume, but I also told you that we have a procedure in place whereby we cannot go beyond 50% of the pre-announced target. So we actually announced 150 billion and we end up having 200 billion. And we do not want to take all the inflows in one go. We wanted to gradually implement our strategy, and market has a limited appetite for fixed bonds. It does not matter whether you took it in a one go or you took it gradually. There's a certain appetite for these type of instruments. So I believe the strategy of the government was right. We wanted to do it gradually. We did it gradually. Now the interest rate has increased. So we can always say that it was a better opportunity to mobilize more amount at that time. But what if the interest rate declined? So you would blame me that you have mobilized more amount at that time, and then this is the right time to now mobilize the instruments because your interest servicing cost will be lower. So I believe government tried its best to gradually implement its debt borrowing strategy, and I think we do not have any regret on that.
Okay. There is another question from Asif Ali Qureshi Saab. What is the status of negotiation with IMF for completion of this outstanding program? Do you have any update on that? You want to say anything?
I would only say that I am a part of a negotiating team, which is basically dealing with the IMF, and things are moving in the right direction rather than a positive direction as of now. It was not stated by the finance even anywhere that this program will be concluded by this date, but I can assure the market that things are moving in a positive direction, and we are quite hopeful that we will be going to resume the program. This is my understanding. As per the negotiation going on, we are engaged with the IMF, and we are very positive that things are going very well in terms of discussion with the IMF.
So, follow up to this question that if the program is, we will unable to complete this review and get this $1 billion release at is projected. So any plan B that you have in that circumstances, because obviously the flows from other multilateral agencies will be difficult to get those flows. So in that case, any alternative plan that we have?
I think then we have to see the possibility of increasing our inflows from the commercial sources, like more bond issuances, and maybe from the more commercial loans from the foreign commercial bank. But I don't see that it is going to be happen. I believe that we are going to be in the IMF program shortly, and negotiations are underway, and that is very positive. So I don't think there's a need to make a plan B, but in case it will be needed, we will definitely think about increasing the proportion of our commercial debt from the international capital markets.
Okay. You mentioned about the challenges of issuance of the Sukuk. Shoaib Saab has asked question, what is the target date for the next domestic Sukuk issue? If you can give some specific dates.
Yeah, we have actually got the, I believe, M3 evaluated, and we got a good valuation of that. I believe that we have submitted the document to the State Bank of Pakistan Sharia Committee, and we are going to get the approval within this week. I mean, in the next 1 or 2 days. Once we get the approval of that Sharia Committee, we are just going to announce the auction calendar. Maybe we are targeting next Thursday or Wednesday for this for the Sukuk issuance.
Okay, we hear a lot about the Panda bond. Any development on this? What type of amount that we're expecting, and when we might see this happen?
Yeah, actually, Panda bond is a lengthy process. It is not like a regular issuance of the government in the international capital market. It requires a lot of regulatory approval from the Chinese authorities, and it also requires a lot of engagement of a lot of services. So you are right in saying that we are unable to issue Panda bond as of now. But after pandemic, the situation was not good in China as well. But now we are engaged with the Chinese authorities, and our financial advisor is working on that. They just recently shared the timeline whereby we require around 22 weeks from now. So we are anticipating that we are going to issue the Panda bond in the Chinese capital market in February, March, if all things goes well as per the plan. So that's the plan. Finger crossed, because there are a lot of formality. We cannot predict that we would be able to do that, but we are quite positive that in Feb or May, you will hear that government of Pakistan has tapped the Chinese capital market. I'm very positive on that.
Okay. There is another question regarding the SDR allocation. Can this allocation be used for budgetary financing? And if it is so, then when do you expect any rupee cover that the government can avail against those allocation?
I think that is a very important question. In fact, I had a detailed discussion with the IMF on this, and we believe that, but rather we have now clarity that government of Pakistan can utilize these flows for the budgetary financing. IMF is very flexible on that. So we are positive that we are going to get this 500 billion worth of flows for budgetary support. And I think once we are in the program, we are going to get these flows from the STR allocation, and that would definitely ease pressure on the domestic market. So we are very certain that these flows will be available to the government of Pakistan shortly. Once we conclude the IMF mission, I think we would be able to share the exact date by when we are going to avail these for the budgetary support.
Okay. A question is regarding the primary dealers where I think government was considering to add NBFCs. So when will we expect that they will be, I think this is the mandate of the central bank to decide the primary dealers. Can you shed some light on this?
Yeah, actually, this is not entirely the mandate of the central bank, but this is also the mandate of the government of Pakistan, that finance division, that we can add the NBFIs if required. But for that, I think if we get the feedback from the market that it can help us developing that primary dealership system better to include this segment, because recently we introduced various reform in the primary dealership system rules. So we can include them, provided we receive some feedback from you, and we can always include them. There's no issue at all in this. So I would like to hear more on this from either from the platform of CFA Society or maybe directly from the NBFIs.
Are there any discussion or strategy to issue shorter tenor Sharia compliant instrument like 6 months or 12 months, like we see in the private sector?
I think it was discussed in detail with the Islamic banks. We like this idea, but no practical action is taken by the government on this. I think we can have a meeting with the Islamic Bank on this to explore this idea further, and if found feasible, we can start with the small amounts, and then we can proceed with the bigger amount as well. So no practical work on this as of now, but we would like to explore this idea further.
Okay. There is a question regarding the impact of recent currency devaluation on PKR debt. If you can add, we have already addressed this. If you want to add anything.
Yeah, I think for the market, I would say that our debt is 86 billion. If the Pak rupee depreciated by 1 rupee, our external debt in rupee term increased by 86 billion PKR. So that math is simple. If we have a 10 rupees depreciation, so 860 billion would be added to the public debt portfolio. So I think I have answered your question.
Then there is a question that maybe there's an incident in a particular monetary policy where the government has not, debt office has not accepted the NPS, where in the next policy the state bank raised interest rate, and then when the monetary policy has happened, they mop up a lot of amount in the next auction. So they were asking that what is the strategy behind, and what is the, I don't know what is this question.
So I'm confused too. I actually could not understand the question. Can you please repeat it? I'm a little bit confused on this.
The question is, I would like to invite your comments on auction acceptance policy. There has been time when just before the MPS, Ministry of Finance rejected very attractive offering. However, just after the MPS policy, they offered higher than usual spread on T-bills as well as PIBs, which gave misleading signal to the market.
I think the comment is fair. And we actually did this that since we had lot of liquidity available with us, and there was some surprise inflows as well. So like FPR overperformed its target by more than 100 billion in the first quarter. So we had lot of liquidity available with the government, and that's why we preferred to retire some of our maturity of the T-bill. And after that, once monetary policy was announced, the participation was quite not well, and obviously government had to meet its financing requirement. That's why we accepted the amount, because government has to actually meet its financing needs. Government do not see that obviously we are mindful of the cost and risk indicator, but ultimately market is one of the funding source for the government of Pakistan. And that's the main reason which I explained to you earlier, that we had a lot of liquidity available with us, and that's why we retired some of our maturities.
There is another question that maybe a simple math is involved in this question, but can you please elaborate on impact of financing cost on government borrowing with every 25 basis point increase in policy rate?
Right. So I think if you can see our floating rate debt, it was around. Let me go to that slide. It was around
15.5 trillion.
5 trillion. So just you need to add up, multiply that 25 basis point. Although the timing of bond, every bond coupon resetting could be different, but if you apply simple math, 15.56 trillion is the exposure of the government, and you just need to multiply it with 25 basis point. That would be the annual impact on the cost of the government.
So there is a question that how much stock of the PAB held by SBP is maturing in FY22, and what is the average time to maturity of remaining amount?
Okay, so in this fiscal year, around 585 billion is going to be mature, and out of which we have already settled 270 billion in August, and the remaining would be settled in the remaining part of this fiscal year. And we had a stock of around 7.7 trillion at the end of FY19, out of which the plan was to retire 600 billion for first 3 years, and then 300 billion for the year 4 and 5. And then there's a big maturity of 5.4 trillion, which is going to be happen in, I believe, 2029. So State Bank maturities was bifurcated, 30% up to 5 years and 70% was for the year 10. I believe I tried to answer your question. Hope I'm clear.
Yeah. I have a question that in the budget, the government has projected 610 billion from the PDL, then around 500 billion plus of surplus, provincial surplus, and then 250 billion from privatization proceeds. So it comes to more than 1.3 trillion of that amount. So that looks quite difficult and ambitious target considering the development so far. So how do you see that number and how that can change your financing need for this fiscal year?
Right. So we are basically, as you are aware, that we are in the process of negotiation with the IMF. We are basically revising the target for PDL, first of all, that we are basically rationalizing it, because at that time we was not expecting such a development in the commodity prices, especially oil. But now we are rationalizing those assumptions. As far as provincial surplus is concerned, we do not account for that surplus in our financing calculation. The 4 trillion deficit, which I have shared with you, is the federal fiscal deficit, and that need to be financed. Provinces can even generate 1 trillion surplus, but that is not for me to finance my fiscal deficit. I need to finance the federal fiscal deficit. So provincial surplus reduce your overall deficit. That is fine.
Yes.
But that is not available to the federal government to finance its fiscal deficit. And as far as privatization pursuits are concerned, I would like to say that I am very well engaged with the Privatization Commission on the privatization of those two power plants. There are two plans. One is there are two components of that privatization. One is the debt portion, which is around 100 billion. We are going to refinance that from the domestic banks, and we are shortly floating the RFP for that. And the remaining 55 billion is the equity portion on which financial advisor is working. And now we have basically simplified the transaction in a way that we are only selling the equity of those two power plants to the international investor. So timing could be difficult to predict at that time, at this time, but we are quite hopeful that we are going to recapitalize the debt of those power plants in this fiscal year. So these flows could be utilized in budget financing of around 100 billion. So that is the answer to your question.
There is a question that is interest rate one of the discussion point in the recent IMF review? Do you have any update on this or any comment?
I think this is a mandate of State Bank of Pakistan, and to be honest, I do not prefer to sit on those meetings, and State Bank of Pakistan is dealing with this matter, and this is a mandate of State Bank of Pakistan. So I have no idea on this front.
Okay. Then again, this question is a repeated question, but I mean, if you would like to add, what are the parameters or rationale on which the PIBs of different tenors are issued? Also given, again, the policy rate is mentioned that the 7% when it was, why not issue, the Ministry of Finance issued at that time? If you can, if you please, if you repeat for the, if it is bear repeating, because this question is coming up again and again.
I think that is a very interesting question. I would say that Minister of Finance has issued a lot of fixed PIBs. I'm not sure why market is basically telling that we have not issued such PIBs. We have issued a lot of PIBs. If I could share the data of the issuances, I think, let me check, but I think on an average we issued around 175 to 200 billion in the 6 months period, because market started participation in these bonds, I think from the April onward. I believe market has a big majority coming up in April and in July. And that's why market appetite is there. Market started participating in this bond auction, and we accepted a very reasonable amount, I believe, in this auction. But now we are, since interest rates are moving up, we would be very mindful in terms of issuing more fixed rate bond. If we get the bond at a reasonable price, we are still interested in issuing fixed rate bond. But as I said, we have given ample option to the market. Now they have a lot of instrument available. As per their risk appetite, as per their preference, they can invest in these bonds and get a good return out of it. So I believe that market would not follow the traditional path whereby market will basically restrict itself in the 3-month T-bill. We have a very good instrument that is 2 year. That the duration of that bond is just 15 days, while T-bill duration is 3 months. So I think you have ample options available now, and you should. I encourage you to basically participate in these instruments.
Okay, again, we have a question that regarding the external financing requirement, considering this widening current account deficit, and are there any target for SPP reserve at FY22 end?
I think SPP would be able to better answer this. I can only tell with respect to debt management, we are expecting inflows of around 21 billion, excluding that STR valuation. If we get that in the budget, which I am positive we will, so our external inflows would be much higher, but that STR allocation is already included in the reserve, so I'm not going to double count it. But for budgetary purpose, we are going to have around 21 to 23 billion inflows, and our maturities are 14 billion. So 8 to 9 billion would be available to the government of Pakistan, and I don't see pressure on the reserve of the central bank in this fiscal year at least.
Okay, there's a question that the government has borrowed $3.5 billion through Eurobond what are the parameters that determine that this is the optimal level to lengthen the maturity profile? Government had option to borrow more through a fixed rate bond and retire relatively shorter maturity borrowing. Any comment?
So you are talking about the target of 3.5 billion worth of Eurobond issuances,
Yes.
right? And what is the exact question? Sorry, I could not understand fully. Yeah.
What is the parameter that determine this? This is the optimal level regarding the external financing. I think even I
Right.
could not.
Right. So I would say that government prepare a financing plan whereby we target certain type of certain proportion of GFN. Like I told you, our gross financing needs are presently 28% at the end of FY21. So we are targeting 24% gross financing need at the end of FY23. For that to happen, 3.5 billion is the minimum amount which we need to raise from the international capital market. And by the way, these loans are much better than the short-term loan which we obtained from the commercial sources, because these are of the higher tenor, 5-year, 10-year, and even 30-year, and they carry a fixed term. Like we issued 5-year bond at 6%. I believe 6% is a very reasonable rate, keeping in view the rating of Pakistan. So I think this is the preferred source of funding. And for as a debt manager, I would always prefer such capital market transactions, because this is the most transparent way to raise the external debt, and how much we can rely on the concessional multilateral sources. There's a limit to everything. So I think we are a emerging economy. We have a market access. We would like to tap the international capital market more and more.
There is a question that how much of the anticipated inflows of, as you mentioned, the 23 billion, the total financing need, that hinges on the successful completion of the IMF program?
Yeah, this is a very good question, because we are anticipating good inflows from the IMF and World Bank and ADB. Although we got few loan dispersed from the World Bank and ADB without the IMF support, especially from the World Bank. But this is the inflows which we are projected in terms of policy loan. There are two types of loan which these institutions offered. One is the program loan, other one is the policy loan. Project loans is not contingent upon the IMF review, but policy loan does have an impact on the completion of the IMF review. So I believe that we are going to, the impact would be in the range of 5 to 6 billion. This is my early estimate. Obviously, I have to see the calculation, but impact could be in the range of 5 to 6 billion out of that 21 to 23 billion. Yeah.
I think we have already passed the 1 hour that has been allocated for this discussion. So with that, I would like to thank again Mr. Umar for this, for taking out time for this session. And I would also like to thank everyone who joined us with this session. And I hope that it will answer so many questions that on the mind of the investors. So thank you again for your time. And I hope that we will have more some kind of session in the future as well, because so much is happening in the capital market, and we will request you again for maybe very soon for another session.
Thank you so very much. Now, this is my commitment that I will remain engaged with the CFA Society and the other